Hi everyone, welcome back to Saheb Academy. Today in this 13th video of depreciation chapter, we are going to understand what is meant by revaluation of PPE. Now this topic is there in your CA foundation syllabus, but there is only a small part of this topic, not the entire thing. Actually, if you will see the accounting standard 10, which you will have in CA intermediate, right, you will have to study that in very much detail. There you will see this is a really huge topic actually, but here you just have a small part of it in the CA foundation syllabus, and only that much we are going to study right now. Okay, so this video is only meant for CA foundation students, it's not for CA intermediate students, right? So let's begin. Let's understand what do you mean by revaluation of PPE. Let's start. Now see here, the first thing that you have to understand is that in accounting standard 10, initial recognition is at cost. What does that mean? It means that when you purchase any tangible fixed asset or when you acquire any tangible fixed asset, PPE, then you have to record that in the books of accounts at its cost. Okay, and I have explained you in the first video of depreciation itself what does cost mean over here. Cost is not purchase price, it is much more than that. You take the purchase price minus trade discount plus non-refundable taxes plus directly attributable cost and plus present value of dismantling cost, you get the cost of PPE, cost of tangible fixed asset, and this is what you record in the books of accounts. Okay, this is what you capitalize. So that's what initial recognition is at cost in this accounting standard 10. And then we have subsequent measurement. What does that mean, subsequent measurement? It means that how will you measure the asset, how will you treat the asset afterwards. Once you recognize that, and then you have to carry that forward in the following years. Now this is asset we are talking about, it's not an expense, it's an asset. So in the coming years, in the following years, we will have the asset. So how will we show the asset in financial statement? Yeah, all that is known as subsequent measurement. So now for subsequent measurement, accounting standard 10 provides us two ways: cost model and revaluation model. Okay, now the company has the liberty, company has the permission from the accounting standard 10 to choose whichever model they like, whichever model they feel is suitable for their item of PPE. Okay, but now there is one condition. Let's understand. An enterprise should choose either the cost model or revaluation model as its accounting policy and should apply that policy to an entire class of PPE. What does that mean? What is entire class of PPE? It is nothing but just group of assets, just block of assets. For example, if you have 5 vehicles, 5 cars, let's say, in your business, then you will group that 5 cars under vehicles. Okay, if you have 10 pieces of furniture, sofa and whatever, then you will group all those item of PPE into one one under one head. That's called furniture, right? So that is what is meant by class of PPE, entire class of PPE. So you cannot do cherry picking over here. Okay, see, when you are applying the model, you have to apply the model to the class of PPE, not to particular asset. Is that clear? If you have 5 land and buildings, then you cannot say that I will apply cost model to this one, I will apply revaluation model for this cost, for this revaluation. No, you can't do this. This is all land and buildings only. Now these all are land and buildings only. So you will make it as class of PPE, one group, and for that entire group you will apply revaluation model. If you feel that revaluation model is suitable for that, then you will apply revaluation model. Is that clear? You have to apply it to an entire class of PPE. Fine, simple. Now let's understand both of these models. It's really simple. See, under the cost model, what we do is we carry the item of PPE, the asset, at its historical cost. Okay, less accumulated depreciation, less accumulated impairment loss, and then we'll get the carrying amount. Fine. So for example, let's just say you have purchased a building for 50 lakhs. So cost will be 50 lakhs. And then while charging the depreciation, you all know we have two different ways of charging the depreciation. The first one is the basic way, where we do not maintain accumulated depreciation account, or you can say provision for depreciation account. Yeah, that's the first basic way, which is not followed in real life. And the second way is where you maintain accumulated depreciation, and this is what is followed in real life, and AS 10 is also according to that only. Okay, so that is why here you have the cost 50 lakhs minus accumulated depreciation. Depreciation will be keep on getting accumulated in that account. Okay, right, you understood that. And then we have accumulated impairment loss. What is this impairment? See, this impairment is also kind of what? Reduction in the value of an asset only. Okay, other than depreciation, you can say. Technically, it's a bit more than that, but you will study about that in the CA intermediate, not right now. Okay, and it's not relevant also. Basically, what happens is, see, the sudden decrease in the value of an asset because of some reason is called as impairment. And how it happens is, see, this is the carrying amount of the asset, and then we'll have something called as recoverable amount. Okay, recoverable amount. What is recoverable amount? It's higher of value in use or net realizable value. Okay, that's recoverable amount. So we compare these two things. What? Carrying value of the asset and recoverable amount. If carrying value becomes more than the recoverable amount, then what we do is we decrease the carrying value to the recoverable amount. For example, let's just say carrying value is 100 and recoverable amount is, let's just say, 40. Then what will you do? You will bring down the value of the asset to 40. So 60 is your loss. What is that loss? That loss is called as impairment loss. Fine. So that's all it is. Okay, right. So you will study more about that later. Fine, not now. So that's cost model. That's how you carry the item of PPE under the cost model. And then we have revaluation model. Now in revaluation model, what happens is, at certain frequency, what do? We revalue the assets. Okay. Now let's just say here you purchase building for that 50 lakh. Let's just say you did that in 2005. Now what is the value of that building? In reality, if you see, in reality the value of the building will be, let's just say, 5 crores, for example, 5 crores. But if you are following cost model, still today in 2022, the cost of the building still will be how much? 50 lakhs only, because you are following cost model, isn't it? Cost will be 50 lakhs only. But if you are following the revaluation model, then if you had purchased in 2005 for 50 lakhs, then right now in your books the value will be close to the current value, that will be 5 crores. Is that clear? So in revaluation model, what do? Is we revalue the assets. Okay, we revalue the asset to its fair value. Now what do you mean by fair value? Fair value means it's kind of market value only, not exactly, because sometime you will not be able to get the fair value from the market evidence. Then what do? Is you have some other means to calculate the fair value, but you don't need to get into that. It's not relevant for you right now. Just understand fair value is kind of like market value only. That's enough for you right now in CA Foundation. So you will check the fair value and the book value. Okay, the book value, the carrying value of the asset, and the fair value, and then you will bring the carrying value to the fair value. That's what you do in revaluation. Okay, don't worry, we'll see that with an example, you will understand. Okay, so fair value at the revaluation date or the measurement date, you will take that minus subsequent accumulated depreciation. Okay, after the revaluation, after the revaluation you will calculate the depreciation, and then same with the impairment loss also. Okay, so after deducting that, you will get the net carrying amount. Okay, so this is the revaluation model. What do? You revalue the asset to its fair value, kind of like market value. How it will happen, don't worry, I will show you, don't worry. Okay, here this is just an overview. Now see some conditions here. If an item of PPE is revalued, then the entire class of PPE to which that asset belongs should be revalued. Understand? Again, you can't do cherry picking. See here, if you have 5 land and buildings and they are under revaluation model, let's say, okay, and you come to know that the fair value of a certain building has gone up considerably, and you want to revalue that building, then you can't just revalue that. No, you can't do that. If you are going for revaluation of that building, then you have to see how many buildings are there in that same class. Let's just say 5 buildings are there in that same class, in that same group. Then you have to revalue the entire class. Okay, entire class revaluation should be done. If an item of PPE is revalued, then the entire class of PPE to which that asset belongs should be revalued. Okay, that's the first thing. The second thing, see, frequency of revaluation. Yeah, when you will do the revaluation, it's really simple. The accounting standard 10 says that if the value changes significantly and it's volatile, it keeps on changing, then you will do annual revaluation. Every year you will do revaluation of that item, of that class. Okay, but if there is an item, if there is a tangible fixed asset of which the value doesn't change significantly, it's not that much volatile, then you can do the revaluation every 3 or 5 years. Okay, so this is the option you have. Fine. So we have cost model and revaluation model. Now let's take an example of this revaluation model and let's understand, how it will be done. Okay, let's see. Now see, here we have the example. With this, let's try to understand how revaluation will be done, what will happen after the revaluation, and the accounting entries and all these things. Okay, so let's start the example. Let's say there is this guy known as Shivraj who has his business, and in that business he has one tangible fixed asset, PPE, and now he wants to do revaluation of that. So what he needs to do, he has to bring one professional valuer, okay, professional person who will find out the fair value of that piece of asset, that PPE. Okay, so there are two cases over here. Let's say in the case one, what happened was the book value is 10 lakh. Yeah, the cost of that asset is 10 lakh, and the fair value found out by that professional guy is 12 lakhs. So you can easily understand there is an increase over here. Fair value is more than the book value, right? So the revaluation is done. So now accounting standards then says that, you have to revalue the asset to its fair value on the measurement date, on the revaluation date. So how will you do that from the accounting perspective? It's really simple. All you have to do is from 10 lakh, you have to take the asset to 12 lakh to its fair value. Basically, you just have to increase the asset by 2 lakhs, isn't it? That's all you have to do. That's all revaluation is. Fine. Now this event, this increase event is called as revaluation upward. By how much? By 2 lakhs, isn't it? There is an increase of 2 lakh now. If you compare, you can see clearly 2 lakh increase has happened. So this increase is known as revaluation upward. Clear? Easy. Now how will you record this? It's really simple. Understand, we follow double entry system, right? What is the first aspect? Asset has increased by 2 lakhs. The second is that you have made a gain of 2 lakh, isn't it? Just by having the asset for some time, what happened? The fair value has increased to 12 lakhs. So you have made a gain of 2 lakhs, isn't it? So asset is increasing, asset has debit balance. So if it is increasing means you have to debit that. Asset account debit 2 lakh. And then that gain you have to record. But understand, you cannot record that gain in profit and loss account. You can't do that. Why? Because it's not realized gain. It is unrealized gain, isn't it? This is happening just in books. Yeah, this is just happening in accounting. You have not earned anything. You have not got cash or something. If you would have sold the asset, then you would have got the cash. You could have recognized the profit. It would have been a realized profit. But right now here it's unrealized gain. So that is why what you have to do is you have to credit revaluation reserve account. That gain you have to take to a special reserve called as revaluation reserve account. And this is a non-free reserve. This is not a free reserve. You cannot distribute dividends out of this. Okay, asset account debit 2 lakh to revaluation reserve 2 lakh. Is it clear? What is the rule? Debit credit rule. Asset is increasing, you debited that, and then equity is increasing. That gain is equity over here. You are taking it to equity. It's increasing. You are crediting that. Is that clear? Simple. So whenever you have a first time revaluation upward, this is the entry you have to pass. What is the entry? Asset account debit, or you can say PPE account debit to revaluation reserve account. Clear? Simple. And then let's just say what happened was in the second year, the fair value, again Shivraj went for revaluation. That professional guy came, he found out the fair value to be 7 lakhs from 12 lakh. Now this is the book value. Understand, what did you do over here? You took the asset to its fair value. So this became the book value now. Now this is the book value and this is the fair value in the second year. Book value, fair value. So what has happened now? In the second year, fair value has become 7 lakh. So what you have to do? You have to take the asset to the fair value. You have to take the asset, you have to revalue the asset to its fair value. So basically it means you have to take 12 lakh to 7 lakh. So basically the loss is 5 lakh, isn't it? 12 minus 7, 5. 5 is loss. So this event, this decrease event is called as revaluation downwards. By how much? By 5 lakhs. Okay, so now how will you record that from the accounting perspective? It's really simple. Understand, okay, this is very important. This is very important. Asset has decreased now. So when asset decreases, what do? Asset decrease means you have to credit, right? So credit the asset to asset account 5 lakhs. Now what will you debit? Understand, whenever loss happens for the first time, in the first time revaluation, you have to take profit and loss account. Okay, you have to take the loss to profit and loss account. But here this is not first time revaluation. Is it first time revaluation? No, this is subsequent revaluation. First time revaluation has happened over here. First time revaluation has happened over here. This is subsequent revaluation, isn't it? Second time revaluation. So in that case, what you have to do is, whenever you do subsequent revaluation, you have to see previous revaluation, what happened previously. Yeah, what happened previously. So depending upon that, you have to do the treatment of this subsequent revaluation. Previously, what happened over here? Previously there was revaluation upward. Because of revaluation upward, in revaluation reserve we have 2 lakh. So now we have to use this gain, to set off the loss over here. See, 5 lakh loss happened in subsequent revaluation. How much? 5 lakh. And in the previous revaluation we have a gain of how much? 2 lakh. So that gain and this loss needs to be set off, needs to be cancelled by each other. So 2 lakh now, so only 2 lakh will be cancelled. So 3 lakh will be there, right? So this 3 lakh will be recorded as a loss in profit and loss account. Okay, this is the logic. This is what will be done. See how it will be done. Asset has decreased by 5 lakh. And then you saw previously 2 lakh is there in revaluation reserve because of revaluation upward. So now you have to utilize that to set off over here. So you will debit that revaluation reserve account, debit 2 lakhs. Is it clear? So you have utilized, here it was credited, here you created the revaluation reserve. Now you will make an equal debit and cancel it off. Okay, revaluation reserve is cancelled, 2 lakh. And then the balancing figure will be recorded in profit and loss account, 3 lakh. Is this clear? Now you will have a confusion. You will think, why if there is an upward we are taking revaluation reserve, and when there is a downward we are taking profit and loss, not some other thing? Why is that so? Because understand, we are following conservatism principle. Yeah, in conservatism principle, what do is we stay on the worst side from the financial perspective. Yeah, we are conservative. Yeah, we want to be safe financially. Okay, that is why we take into consideration all prospective losses. We record them immediately in profit and loss. But if we have any gain, then we see properly, is it unrealized gain? If it is unrealized, it cannot be taken to profit and loss. If it is realized, then only take it to profit and loss. Okay, this is what conservatism principle says. Okay, prudence or conservatism principle, the same. Okay, so you understood this. 5 lakh decrease happened, and then you saw previously what happened over here. Here there was revaluation reserve of 2 lakh. So you use that to set off the loss over here. Yeah, 5 lakh loss was there. You saw previously 2 lakh revaluation reserve you have, gain you have. So use that to cancel off the loss 2 lakh. So the remaining 3 lakh, you took that to profit and loss. Okay, so revaluation reserve account debit 2 lakh, you cancel that, you took the remaining to profit and loss, and asset has decreased. Now for example, let's just say revaluation reserve was, let's just say 50,000. Revaluation reserve 50,000, and the decrease was of 5 lakh only. So from 5 lakh, how much you can set off? Only 50,000. So remaining 4,50,000 will be profit and loss. It will go to profit and loss. That loss will be recorded through profit and loss account. Okay, so entry would have been like this: revaluation reserve 50,000, profit and loss account 4,50,000, to asset account 5 lakh. Do you understand? Now let's say one more thing. Let's say first time revaluation upward happened, and then second time also revaluation upward only, subsequent also upward only. Let's say here it was 12 lakh now, so you recorded 2 lakh over here, and then let's say here it is 13 lakh fair value. So 1 lakh increase happened. So what will be the entry? The same entry you will pass: asset account debit to revaluation reserve 1 lakh, isn't it? I told 13 lakh now fair value. From 12 to 13, it is 1 lakh increase. So asset account debit to revaluation reserve 1 lakh. You understood? If first time upward has happened, second time also upward, no problem at all. Okay, it's same thing, it's easy. But first time upward and then second time downward means you have to see properly what happened previously. Okay, what happened previously, because sometime you will have to set off like this. Okay, fine. So that was the case 1. You understood that. Now let's see case 2. Now see, in the case 2 what's happening is the book value is 10 lakh and the fair value is 8 lakh. Okay, that professional guy said the fair value of that machinery is 8 lakh. So now you can clearly understand here there is a decrease, isn't it? 2 lakh decrease is there. So this event is called as revaluation downward. By how much? By 2 lakhs. Okay, so now how will you record this in the books of accounts? It's really simple. I told you, whenever there is a loss, what does conservatism principle says? You have to record the loss or provide for the loss, isn't it? So you will record the loss through profit and loss account. Okay, whenever there is a first time revaluation and you have a revaluation downward, you have a decrease, then you will always record the loss like this. Always profit and loss account debit to asset account. How is this? Asset value has decreased by 2 lakh now. Asset value has decreased by 2 lakh. So you will credit the asset, and what will you debit? You will debit the profit and loss account. Yeah, you have to record the loss now. How do you record the loss? Let's understand this. See, it's really simple. Asset has decreased. You have to credit that to asset account 2 lakh, and then loss also you have to record. What is loss? Loss is invisible expense, right? It's an invisible expense. So how do you record expenses? You have to debit that. If loss has happened, it means loss is increasing. Understand? So profit and loss account debit 2 lakh. Simple. Okay, so write this somewhere. Whenever there is first time revaluation and it is revaluation downward, then you have to always take it to profit and loss. I'm talking about first time revaluation. Okay, right. Now let's see what happened. What is the subsequent revaluation? See, subsequently what happened was the fair value was 11 lakh. This is first year, and then second year what happened? Second year that Shivraj guy again went for revaluation. Okay, again he went for revaluation. So now that professional guy told him that fair value is 11 lakh. So now if you compare, this book value in the second year, this is the book value. This book value with this fair value, you can clearly see, there is an increase of how much? 3 lakh increase is there, isn't it? From 8 to 11 means 3 lakh increase is there. So that 3 lakh increase is what? Revaluation upward. This event is called as revaluation upward. So now what will you do? Revaluation upward is there. By how much? By 3 lakhs. Yes. So now what you will do? Whenever you have such a situation when subsequent revaluation, it's not same with the initial revaluation. Yeah. Here you had downward, here you are having upward. So what you have to do? You have to see previously. If you see previously, then here you can see you have a loss recorded of how much? Of 2 lakh, right? So see, let's see how you will be recording this revaluation upward. See here, in revaluation upward here, 3 lakh increases happened. So asset account debit 3 lakh. Simple, easy. Then what you will do? How will you record this gain? This 3 lakh increase you cannot directly record as revaluation reserve 3 lakh. No, you can't do that because this is subsequent. Always remember, whenever you have a subsequent revaluation, always you have to look back. What happened previously? Previously, what happened over here? Previously, you have recorded a loss of 2 lakh. There was a revaluation downward. So you have to set that off. You have to cancel that off with the gain you have made over here. Okay, understand? Asset has increased by 3 lakh. Now you will utilize the profit and loss. To profit and loss, 2 lakh. What is happening over here? See, 3 lakh gain has happened. But previously you have made a loss of 2 lakh. So that loss you will reverse. Okay. So you will have left gain of only 1 lakh. And this 1 lakh will go to revaluation reserve. Do you understand this? It's really simple. It's not difficult. It's not difficult. First time you made revaluation, you had a loss of 2 lakh. You recorded that in profit and loss. And then second time revaluation, subsequent revaluation, you got revaluation upward. Now here what do? You have to look back. What happened previously? 2 lakh loss we have recorded. So that loss will be reversed over here. Here you have made a gain. Now 3 lakh gain is there. You can't record entire 3 lakh gain in revaluation reserve. No, you can't do that. You cannot do that. You'll only record 1 lakh. How 1 lakh? Because previous loss is reversed. See, asset account is getting debited 3 lakh. Okay, it has increased now. Asset is increased. No doubt about that. but the gain completely will not go to revaluation reserve. Instead, 2 lakh gain will be utilized to write off the loss, previous year loss. Okay, to profit and loss account 2 lakh. Here it was debited now to record the loss. So to reverse the loss, what you have to do? You have to credit. See the rules of debits and credits. If you want to reverse the expense, reverse the loss, then you have to credit that. Okay, to profit and loss account 2 lakh, and then the balancing figure, the remaining will go to revaluation reserve. Okay, always remember, whenever you have a subsequent revaluation, you have to look back. What happened previously? Do I have loss or do I have revaluation reserve previously? Depending upon that, I have to do the treatment in subsequent revaluation. And this revaluation reserve is also known as revaluation surplus. Okay, it's also known as revaluation surplus. And now let's say, for example, let's just say here it was how much? Let's just say here there was only 1 lakh. Only 1 lakh loss was recorded, okay, in the first revaluation, and then in revaluation upward, here we had 3 lakh gain. So what would have happened over here? Asset would have increased by 3 lakh as usual, but since in profit and loss here only 1 lakh loss was there previously, so only 1 lakh will be reversed. Only 1 lakh loss will be reversed. Remaining 2 lakh gain would have gone to revaluation reserve. Okay, like this. Let's say, for example, first revaluation downward happened, the same, and second time also revaluation downward happened, let's just say of 5 lakhs. Here revaluation downward happened of how much? 2 lakh, and then revaluation downward happened of 5 lakhs. So what will you do? The same entry you will pass. Profit and loss account debit to asset account 5 lakh, 5 lakh. I told you now, whenever you have upward, the same entry. Asset to revaluation reserve, asset to revaluation reserve. 2 lakh, and let's just say here there is a decrease of 1 lakh, then 1 lakh, the same entry. Here also downward means same entry you will pass. Profit and loss to asset, profit and loss to asset. Whatever the amounts are, you will take. Is it clear? But if it is different, downward and upward in the next year, then you have to look back, see, and set off properly. Okay, it's really simple. Okay, right. So this is how it is, revaluation upward and downward. I hope you have understood this. Right, so now let's just move on to a problem which we have, it's practical question number 5 or 4 something. Let's see that, and then we'll try to see one more problem, and then we'll end the video. Okay, let's go to the problems now. Now see, here we have the problem on revaluation. It's really simple. From our series, this is the 14th problem, but from the ICAI study material, this is the practical question number 5. Okay, so let's read the question. See here, Amazing Group had PPE with a book value of 35 lakhs. Okay, the book value is 35 lakh on 31st December 2019. The balance in revaluation surplus, or you can say revaluation reserve, on that date was 3 lakhs. Okay, with this sentence we can understand that there has been a revaluation done, and there was a revaluation upward of this PPE, and because of that they have 3 lakh in their revaluation reserve or revaluation surplus account. Fine. Okay, as part of their practice of revaluing the assets on yearly basis, another revaluation was carried out. Another revaluation means this is subsequent revaluation they are talking about, and that is what we have to solve over here. Subsequent revaluation was carried out on 31st December 2019. Okay, evaluate the impact of revaluation if the fair value as a result of revaluation done on 31st December 2019 was 37 lakh, 33 lakh, 31 lakh. Also give the journal entries. So here they are asking, if the fair value would have been 37, then what would be the treatment? If it would have been 33 lakhs fair value, then what would be the treatment? If the fair value was 31 lakh, then what would be the treatment? Okay, so 3 different questions they have asked over here. So let's solve one by one. It's really simple and straightforward. The first one is what? Fair value is 37 lakh. Yeah, book value is 35, and there has been revaluation happened before, and because of that there was a 3 lakh revaluation surplus. Previously we had revaluation upward revaluation was there. Now here we are having subsequent revaluation. Now here what do we have now? Is it upward or downward? See properly, compare book value with the fair value. Book value is 35 and fair value is 37. Fair value is more. If fair value is more means this is revaluation upward, right? Previously also upward, now also upward. So what entry you will pass? Simple. See here, there is a revaluation upward by 2 lakhs. 35 minus 37, 2 lakh increases happened. So this increase you will record, really simple, property plant and equipment account debit, or you can say asset account debit. Yeah, asset account is increasing now by 2 lakh, so you will debit that, and the gain you will directly take it to revaluation surplus or reserve account. Okay, it's the same thing, 2 lakh. Now understand why did I pass this entry, why there is no set off and all. It's because previously also we have revaluation upward only, and now also we have revaluation upward only. It's same, so that is why same entry is passed. Okay, there was no loss or something to set off right here. Is it clear? So PP account debit to revaluation surplus or reserve account, 2 lakh 2 lakh. Is it clear? Simple. Now the B question, 33 lakh, fair value is 33 lakh. So here what is happening, what is the event? Is it revaluation upward or downward? Book value is 35, fair value is 33. You can clearly understand fair value is less than book value, right? Market value has fallen from the book value. Book value is 35 and fair value is 33. It is less by 2 lakhs. It is decreased. It has decreased by 2 lakhs, isn't it? Yes. Compare the book value with the fair value, not this 37 and 33. Don't do that. That's stupidity. So the decrease is by 2 lakhs. So that is revaluation downward by 2 lakh. So now how do you do it? Whenever there is revaluation downward, after a revaluation upward, what you have to do, you have to look back. How much you have in revaluation surplus? You have 3 lakh in revaluation surplus. Now understand, in this B question, how much loss is there? Loss is there of 2 lakhs. Loss is there of 2 lakhs. Isn't it? Revaluation downward by 2 lakh. Now 2 lakh loss is there. So you have to look back. What happened in first revaluation, previous revaluation? In previous revaluation, there was a revaluation upward, and because of that we have a gain of 3 lakh. So utilize that gain to write off this loss. You have 3 lakh gain, so you can take 2 lakh gain of that and write off this loss completely. Okay, write off this loss completely. Is it clear? Do you understand this? So that is why there will nothing be recorded in profit and loss account. Nothing will be recorded in profit and loss account. See here, the entry would be revaluation surplus or revaluation reserve account debit. Yeah, you are utilizing that. Do you understand? You are utilizing the equity. Yeah, you are utilizing the revaluation reserve. Utilizing means you are decreasing it. You are utilizing it to write off the loss which happened. Okay, so revaluation surplus account debit 2 lakh to property plant and equipment 2 lakh. Isn't it? Asset decreased by 2 lakh. No doubt about that. You have to credit that. Whenever asset decreases, you have to credit. But why are we debiting revaluation surplus? Because to set off the loss. How much loss is there? 2 lakh loss is there. So we utilize the revaluation surplus by 2 lakh. There was 3 lakh there, but we could take 2 lakh out of that. We did that and we set off the loss. Clear? Easy, isn't it? I showed you now in the previous example also what was happening over here. 5 lakh loss was there, right? 5 lakh loss was there. So what did we do? In revaluation reserve we had 2 lakh. So we used that 2 lakh to write off the loss. Then remaining 3 lakh was recorded in profit and loss account, isn't it? But here what happened? In this case what happened? In this case loss was less. It was only 2 lakh. In revaluation surplus we had more, 3 lakh. Here we can completely write off the loss, complete 2 lakh. So there was nothing recorded in profit and loss account. Simple? Understood. And then we have C. In C what is happening? The fair value is 31 lakh. Okay, so 31 lakh means revaluation downward, isn't it? By how much? By 4 lakh, isn't it? Compare 31 with 35. Book value is 35 and the fair value, the market value is 31. So of course the value of your asset has fallen. It has decreased. By how much? By 4 lakh. Revaluation downward. Okay, so total loss is 4. Understand this, it's really simple. Use the fingers. Total loss is 4 lakh. Okay, total loss is 4 lakh. And then look back. In the first revaluation you have revaluation surplus of 3 lakhs. So you can take this 3 lakh and write off the loss. You can set off the loss. Okay, so only 1 lakh will be recorded in the profit and loss account. Do you understand? 4 lakh total loss happened. You had 3 lakh in revaluation surplus. So you use that and you set off 3 lakh loss. Okay, so 1 lakh will be recorded in profit and loss account. Is it clear? See here how it will be recorded. It's really simple and straightforward. Asset has decreased by 4 lakh, no doubt about that, to asset account or to PPE account. Okay, you will credit that. And first thing is you will set off the loss by revaluation surplus. Okay, revaluation surplus or revaluation reserve account debit 3 lakh. I explained that to you now how it is 3 lakh. You will take this to write off not this entire 4 lakh, 3 lakh of this 4 lakh. Okay, and then remaining 1 lakh will go to profit and loss account. It will be recorded. It's that simple. Revaluation surplus account debit, profit and loss account debit 3 lakh, 1 lakh, 2 PPE 4 lakh. Is it clear? Simple and straightforward, right? So this is the practical question number 5 for you. It's really simple and straightforward. Okay, now let's move on to the another problem. Now see here we have our 15th problem, but actually this is from the ICAI study material illustration 12, and here we have got revaluation as well as there is change in useful life. Okay, so let's see how it will be solved. A machine of cost 12 lakhs is depreciated straight line. Okay, straight line method they are saying, assuming 10-year working life. Okay, useful life is 10 years and 0 residual value. Residual value is 0, scrap value is 0 for 3 years. At the end of the third year, okay, they depreciated for 3 years, and then at the end of the third year the machine was revalued upwards. Okay, upward revaluation is happening by how much? By 60,000. So 60,000 increase has happened. The remaining useful life was reassessed, revised at 9 years. Okay, so let's see what happened over here is they are saying they had a machine of 12 lakh, cost was 12 lakh, useful life was 10 years, residual value is 0. So you can easily calculate the straight line method of depreciation, isn't it? 10 lakh or 12 lakh, right? So 12 lakh is the cost minus scrap value 0, that's equal to 12 lakh only. Divide that by the useful life 10, you will get the depreciation, isn't it? I just use the SLM formula, right? So 1,20,000 is what? This is the depreciation, annual depreciation, which is constant in SLM, isn't it? See here, it's like this. 12 lakh minus 0 divided by 10, that's equal to 1,20,000. This is the depreciation every year. 1,20,000, 1,20,000, 1,20,000, and they did that for 3 years. For 3 years, they depreciated the asset like that. Okay, and then what happened was at the end of the third year, the machine was revalued upwards by 60,000. Yeah, so what you have to do is whenever there is revaluation or whenever there is change in useful life or change of anything, what you have to do is you have to calculate the written down value over there, written down value or the carrying value over there, right? So how will you calculate that? That's what you have to always do. Always you have to calculate first the written down value, the carrying value at that point of change. So here the change is happening, there is change in the value of the asset. Yeah, revaluation means what? Value of the asset will change, and then there is change in useful life also. At the end of the third year, what is the remaining useful life? Remaining useful life is 7 years. If 3 years has been passed, remaining is 7 years now, 10 years the total life. But they are saying at the end of the third year they reassessed, they revised the life to be 9 years, 9 years remaining life. Okay, so there is a change. So if there are changes like this, then of course the depreciation will change. Depreciation will change, and that is what we have to calculate. What we have to calculate over here? Depreciation for the 4th year. Okay, depreciation for the 4th year. It's really simple. Let's see. What did I say? You have to calculate the WDV. So how will you calculate the WDV? It's really simple now. Just take the cost 12 lakh and then subtract these depreciations. Do you understand? Just take the cost, subtract these depreciation, you will get the carrying value, isn't it? That's how you calculate the WDV now. WDV at the end of the third year means you have to take the cost. This is the cost. Okay, this is the cost 12 lakh. See, 12 lakh minus open bracket, see 1,20,000 into 3. What is this? Depreciation, annual depreciation into 3. 3 years depreciation you have to subtract. So you will get the carrying value. 1,20,000 into 3 bracket close, that's equal to 8,40,000. Yes, 8,40,000 is what? This is the carrying value at the end of the third year, or you can say written down value at the end of third year. Okay, so that's 8,40,000. Now you have to increase this. You have to give the effect of revaluation over here. You have got now 8,40,000. Now here they did the comparison. See, when the revaluation happened over here at the end of the third year, the machine was revalued. Here revaluation happened. So this is the book value. This is the carrying value. So revaluation is happening, right? Revaluation is happening. How much is that? Upward by 60,000. 8,40,000 plus 60,000. So that's equal to what? That's equal to 9 lakh. Do you understand? 8,40,000 was the book value. 60,000 increase happened. So 9 lakh is the new carrying value or new written down value. Is it clear? How much is it? It's 9 lakh. You understand this? It's really simple and straightforward. And then they are saying, and then what happened? Useful life also changed. If there was no change in useful life, then what would have happened? If there was no change in useful life, then what we would have done is, see how we would have calculated the depreciation for the 4th year. Let's understand that without the change in useful life. We would have taken this 9 lakh. Okay, this is the cost. Now this WDV will become the cost for us now, because here we will be calculating depreciation again in a different way. Same formula only, but this will change. Okay, WDV will become the cost now. Whenever there is a change, WDV will become the cost. We'll consider that as a cost. So this 9 lakh will become the cost. What is the formula of SLM? Cost minus residual value divided by useful life, right? So 9 lakh minus 0, that's 9 lakh only, divide by not useful life. Whenever there is a change, what you have to do is you have to take remaining useful life, not useful life, not 10. You have to take the remaining useful life, because there is a change over here. And then what is the time left? The time left is 7 years. The time left is 7 years. Yeah. If there was no change in useful life, what is the time left? 7 years. So divide by 7. That's equal to, how much? 1,28,571. This would have been the depreciation had there been no change in useful life. But there is a change in useful life. So what we have to do? If there is a change in useful life, then just change the life. They are saying revise useful life, remaining useful life is 9 years. So just take 9 years. That's all it is. Okay. So see, how will we do it? Same 9 lakh you will take. We'll consider the written down value as the cost minus the scrap value, which is 0. Nothing is there. So that's equal to 9 lakh. Right. Divide this by what? Remaining useful life, and the remaining useful life they have said was reassessed at 9 years. Remaining useful life is 9 years. So just take that, divide by 9. That's equal to 1 lakh. 1 lakh is the depreciation. Do you understand? Depreciation for the 4th year. See how it will be calculated. It's really simple. First we calculate the WDV. We got 8,40,000. We gave the effect of revaluation plus 60, that was 9 lakh. And then we have to calculate the depreciation for the 4th year. 9 lakh WDV is considered as a cost minus scrap value divided by remaining useful life. This is what? Understand? This is not useful life. This is RUL, remaining useful life. Okay, revised remaining useful life. Revised. It is changed now. So revised remaining useful life. Is it clear? Yes. So 9 lakh minus 0 divided by 9. So that was equal to 1 lakh. 1 lakh is the, sorry, can you see that now? 1 lakh is the depreciation of the 4th year. Clear? Simple and straightforward. So whenever there is a change, what you have to do? You have to calculate the WDV at that point of time, and then give the effects, everything, and then put the values in the formula. Whatever change is there, just include that in the formula. Okay. Now in the following video, we'll discuss more about changes, change in method, change in useful life also. We'll discuss all these things again. Okay, not revaluation, but change in useful life and change in everything else. Okay, method and all. Fine. Okay, so that's it for this video. I hope you have understood the revaluation part, and this was the the relevant part only we have studied. Actually, revaluation is a very huge topic. Okay, you will study that in the AS10 in CA Intermediate. So yeah, so that's it for this video. See you in the next video. Bye.